Bring that ass back like a boom, 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 boom.
Good morning. It's Sunday. You're with Boom Traders weekly overview for the August 14 week 32 of 2022. I'm Supernova and let's get it going. So, just as usual, we have the session overview right here, risk vest model, tactical trading environment. We've changed those two a little bit, current markets, and summary. First things first, our risk vest model is now on buy caution. What does that mean is that we are basically loading it up, but exercising some caution. Now that you not have to exercise caution at all times, but the market has done some positive things, positive developments that are giving us some, some wind in our bags that we can actually get in a little bit more aggressively than we've been doing so far. Still, it's a primarily risk-off environment. We're still thinking that especially big, large institutions are most probably going to try to sell into this rally right now. And you will see we're coming into some collision areas, some resistance areas. We are also seeing a lot of volume coming from retail traders. Volume is not as elevated as it should be if we are really seeing the market lifting. But nevertheless, it's a positive development. So we are thinking that you might want to exercise a little bit more buying, but of course with caution. So some of the components of the risk vest model, general market up down volume still positive from last week. New highs, new lows now moved to neutral. You see there's like the plus indication that we moved it once. Stock participation still on neutral. And as far as the tactical trading environment, we moved it from hard penny to caution. Basically, with caution, the market is still highly rotational selective. You can trade, and as I said, exercise caution. So we do see some improvement, but again, we need to be careful about because you will see in just a couple of slides the zones that we are reaching are resistance zones. So as far as the current markets, we're going to take a look at some charts, then we're going to take a look at my notes, sentiments, and then we're going to do a summary. This week, I'm going to skip the strong groups of the market because we are doing this in our Discord server anyways every Monday. So I don't really want to get repetitive with this section right here. And again, try to keep this video shorter so you can watch it and then be prepared as fast as you can for the Monday market opening. So without further ado, let's take a look at some charts. So the first thing I want to bring your attention to is the chart of the S&P 500. This time I'm going to use Thinkorswim because I'm better at coding Thinkorswim, and I do have a code here where it's basically an indicator that I use for stocks, but I just wanted to show you here on the indexes as well so you get an understanding of what I'm seeing. So first things first, we broke out of this little sort of a tight flag, consolidation zone right here. And we did on volume. Like if you look at the volume for the past 3 days, that is since Wednesday. This is on Wednesday when the CPI numbers came. We had this gap on pre-market. And there was some volume. And also you can see the volume has been all positive right here. But what is actually important, we are getting extremely close to the 200-day moving average. That's this purple line. And I'm thinking that right here we might see some resistance. We might, get a little bit above it and then start to churn right here. If we manage to consolidate right here around this 200-day moving average without, dropping further a couple of percent, no more than 5%, I would say, that's a very positive action from the market. Now it's debatable whether we're going to see this. The indicator that I wanted to show you, and it's basically standard deviation from the 50-day moving average. So basically, what it is showing is that price right now, this is the cyan line right here, the price right now is, hugging the standard deviation, and I use 1.8. You can see right here, I use 1.8 standard deviations from the mean, and that means that the price is really extending away from the 50. And you can see that pretty much every time we hit that deviation right here, we went above it or below it. On the downside, we've had some correction. So we had it right here. You can see this bottom right here. You can see this bottom right here, this bottom right here. Here was the top. And then we have, I think right here is another bottom. Right here, definitely a bottom. Here we touched it. We couldn't go for. Right here, there's another bottom. So every single time this signal line goes beyond the standard deviation zone, we do see some sort of a reverse. So I use this for stocks mainly, but it's an interesting just a position to see it for the indices. So as I said, we're approaching the 200-day moving average on the S&P 500. Usually that's a huge resistance support zone depending on which side on the line you're approaching it. And then of course we have this extension in terms of price compared to the 50-day moving average. You can play with this. I use it with the 20 and the 50-day moving average, but you can certainly play with it. QQQ, the Nasdaq, same thing right here. You can see right here at the bottom right of my screen, we are again a little bit extended, not as much as we were last week. We're basically hugging this upward standard deviation, so not looking rosy, and there's still some room to move for the QQQ to reach the 200-day moving average. We still have like 12 points up and above. Another thing that I was noticing here, volume is not as substantial as it was in the S&P 500, and actually we had a negative day on Thursday, whereas let's go back to S&P 500, whereas on Thursday you can see we had a negative day, but volume was positive. So there was a change. And last but not least, IWM, not WM, it's a component of IWM. So IWM broke through the 200-day moving average. As I said in chat, that was like the strongest index. It's just crazy how strong IWM is, and usually that is a positive sign when IWM, the small caps, is outperforming S&P 500 and the Nasdaq. So it's a good sign. Again, we do have volume, that's good, but we are very extended. And looking at Dow, you can see the exact same thing. Approaching the 200-day moving average, volume was 3-day positive, although that was a negative day. And if you look, if you look right here at the bottom, this is quite elevated in terms of standard deviation from the 50-day moving average. So we definitely need to be looking at some, well, at least trimming the positions. I wouldn't necessarily say, close them all. And I loaded the boat on Friday with some breakouts that I was looking at. I wouldn't necessarily say close it all. I'm expecting a gap up on Monday. Maybe then you'll have to tighten your stop to see whether this gap up will hold or it will fail. And then we're going to see this this consolidation that I'm thinking we're in for. Now, let me just show you a couple of things that I'm watching for the markets intraday, and then we're going to look at the indicators. You can see right here, this is for New York Stock Exchange, and I have it for NASDAQ. I also have it for the Russell 2000, so it's the IWM. The first bar right here is the up-down volume, and now we have 7.48, which means that the up volume is outpacing the down volume 7 times 0.48. The second one right here, we have the advancing against the declining issues. We have 4.2 to 1 advancing to declining, and then we have net highs, net lows. We have 33 net highs. So all positive action on Friday. The only thing that was really missing was volume, and here you have this little bar right here that I've coded, and it's just volume. It's 95.4% of the 20-day moving average, and you can see it right here. I have it also at the bottom as histogram, but that's basically what it is. Put call ratios are extremely low. You can see for the S&P 500 0.71, for the QQQ 0.75, IWM 0.39. So that was like all gold buying. Almost no hedging right here. And for Dow, it was 0.78, 79, sorry. For Nasdaq, you can see basically the same thing. Volume is 79.4% of the 20-day moving average. You can see right here. And as far as the up-down volume, 4.58. It's very positive. Advanced decline ratio was lower than the New York Stock Exchange. It was 2.78 to 1, and net highs, net lows, 35 net highs. And here we have the root. It doesn't provide statistics regarding the net highs and net lows. And if you're wondering why the volume is in red, I just want to have it in red to grab my attention when it goes above the 100%. It has nothing to do with whether volume is positive or negative. As you know, DOS cannot provide you with that data. So for Russell, we had 4.3 advance against decline. Up down volume, and 6.1 to 1 advancing to declining issues. So a really positive day for IWM. And now, as to look at the indicators, I'm just going to maximize this a little bit. I use, this is the VIX on top of it. I just have it right there. And those two indicators don't have anything to do with the VIX. I just need to see the VIX somewhere on the screen, so I just place it here. So both of these indicators are based on the advanced decline issues and the up-down volume. And you can see I have some lines here that they need to oscillate between. If they go above those lines, they're overbought, meaning that we are extended. And I use this in conjunction with technical indicators like the standard deviation, as I showed you just a couple of minutes ago. Technical resistance lines like the 50, the 150, the 200-day moving average, so forth. But this is an indication that we are getting overbought, and usually when that happens, you can see that we have some sort of pullbacks. So this one is based on the advanced decline ratio in terms of volume. And this one is based on the advanced decline issues in terms of number of stocks. So both of them are showing that we are getting really extended, and they usually speak in unison. But I like to see both of them because sometimes there'll be interesting divergences that are happening in the market, and you can trade off of that. So there's one more indicator I want to show you, and it's the Martin Zweig breadth thrust. It's basically based on the advanced decline issues as well as volume and some other technical indicators. But in general, you can see that once it reaches this red, upper red or the bottom red, the thick lines, we are getting overbought, and especially when we hit the white lines, these are the absolute extremes. You can see right here in January this year, and then in June of this year, we hit the extreme oversold. Market rallied both times. Now we're hitting almost the extreme overbought. So it's up to see how the market will react. And with this, I'll take you to my notes. And the first note that I have right here is about the recession. So we are getting some sort of mixed signals here, whether there will be a recession or there won't be a recession. Some signs that the inflation is, peaking. We have the commodity prices, as Tim mentioned last week. Oil, wheat, lumber, copper, they're all down to 30, 40, 50, even 70%. Apartment rent increases are starting to flatten, so basically no more increases. As we mentioned a couple of weeks ago, Tesla reported that the cost of goods is declining within their production lines and factories. Best Buy is following Walmart, cutting some prices. Crop prices are lower, which also mean that food price will also most probably, of course, go down. Home prices did dip in July. And as Tintin mentioned last week, I just want to repeat this. The Fed said that they are data dependent, basically meaning that they are now monitoring closely to see whether they could slow these rate hikes in terms of percentage of points for the hike. Initially, for the next month, we had a projection of 100 points, but now I think this is off the table, and we're most likely seeing something like 50 to a maximum of 75 points. It might look like they're ready to, I mean, the Fed are ready to pause or stall the hiking sooner than people are expecting. But on the other side, we have indicators like the WLI from advisor perspectives, and I really urge you to check their website. They have a lot of free stuff that is really interesting. But this indicator, you can see right here, it's dipping um, very low, and it's going to places that suggest there is some sort of recession coming. You can see rarely if we dip below -10, we are able to withstand recession. And in 1990, you can see, and 2010, 2002, there were all times that we dipped, and it was actually a shallower dip than it's right now when we all went into recession. So I think that's a given one. Another thing that I want to point out here really fast is the cycles and the cycle work from Ned Davis research regarding NASDAQ, S&P, and Dow Jones Industrial. You can see where we are right now, and this blue DO line is basically the cycle work. So it might be suggesting that come October, we might see, well, late September, come October, we might see an undercut of the lows and then a sharp rally. Now, this might be delayed a little bit for the end of the year or even beginning of next year, but that's what the NASDAQ cycle work suggests. For the S&P 500, you can see it's suggesting a bottom right here and just straight off. So it's up to see maybe some consolidation here late August. In September, we'll see how it goes. And for the Dow Jones, this is the Dow Jones 4-year presidential cycle. Also, this looks like October to me. September, October, we might see another low. This is the second presidential year. We go into the strongest one, which is, as you all know, the third presidential year is like the strongest one, and then we have the election year. So this is what Dow Jones cycles for the presidential cycle suggest. And sentiment suggests that we are seeing more bullishness, in market participants. But what is still important to note is that the 32.2% bullish are still lower than 36.7 bearish. So bearishness is coming down. Of course, bullishness is coming up. But it's not like all out bulls out there. Sentiment is sort of contained. You can also see this with the fear and greed index and CNN's reading of the 7 components. They have it on neutral. Previous close that was for Friday. They had it on 54. So neutral 1 week ago was 49. 1 month ago, remember, it was 23. And this is how the line actually looks like for this year. So we started around here, about 70. Then we've dropped to pretty much all-time lows right here. And then now we've started, moving back up. So that's sentiment. And for Bitcoin, although price is not moving much, you can see price has been stalling here at the bottom. We do see the fear and greed index moving into neutral territory, pretty much following the general market fear and greed sentiment from CNN. For the summary, guys, as usual, risk vest buy caution. We mentioned it. The setups are selective, although there's a proliferation of stocks. I've gone over 1,000 charts this weekend, and there are some really nice setups. The market is testing. It's going forward. It's right at the resistance lines, right below the 200-day moving averages. Overbought on some of the market timing indicators. So be careful. Put volume is neutral to bullish. If we see it, the overall put volume drop below 0.7, that's very bullish. Volatility is decreased, and you can just judge it by looking at the VIX. I mean, VIX has been it's been beaten down. And as far as some factors that are affecting the market, definitely the looming recession. That's hands down number one. Of course, there's the war in Ukraine. There's COVID. There are some supply shortages. There's the tension between China and Taiwan. So there is a lot of talk about. But at the end, get involved. Of course, think about the risk. and stop thinking about news. Stop watching the news so much. Focus on the charts and the setups. If there are setups and charts are set up for you to trade, the market is telling you something. So don't be so obsessed about the news, because the market is, it's a cliche, but it's a discounting mechanism. It's looking forward and it's already pricing in what everybody else is thinking, their emotions, and the things that are in people's heads. So I think it was a pretty productive week. I'm looking forward to the next week, and I hope this information was valuable to you. If you like it, please feel free to like the video. Please feel free to turn on those notifications so you don't miss another upload from our trading community. And if you are into trading, if you're interested, please join us in Discord. There are a lot of information there, and a lot of very, very cool people that will help you with your trading. So until next time, see you guys. Bye bye.